for sure that you finally found a broker on Wall Street that you can trust.
Scroll to the end credits of The Wolf of Wall Street. Past the actors, past the crew, past the thank yous to Martin Scorsese's family. There it is. Special thanks to Joe Low, a film about financial fraud, about a man who stole millions through lies and shell companies, was financed by one of history's largest embezzlements. $4.5 billion stolen from Malaysian taxpayers, laundered through Hollywood, hidden in plain sight. The irony isn't accidental, it's structural. Hollywood didn't just ignore where the money came from. The industry is designed to launder it. Movies are perfect crimes disguised as art. Start with the budgets. A film costs what someone says it costs. What's the fair market value of a screenplay? Of a director's vision? Of development? There's no invoice for creativity. No receipt for a rewrite. Just line items that say, script acquisition, $2 million with nothing to audit against. Then there's the international structure. Film financing crosses borders constantly. Production companies in one country, sales agents in another, distribution deals spanning dozens of territories. Money moves through banks in Singapore, shell companies in the British Virgin Islands, and back to a studio lot in Los Angeles. All of it legal on paper, all of it impossible to trace in practice. The documentation gap makes it worse. Manufacturing has inventory. Real estate has property records. Films have nothing physical until they're finished. Just contracts for services rendered and invoices for creative consulting. Try auditing that. The 1MDB mechanism exploited every gap. Malaysia's sovereign wealth fund was established in 2009 for infrastructure development. Joe Low and his associates diverted funds through Goodstar Limited and other shell companies. $155 million flowed to Red Granite Pictures for the Wolf of Wall Street production. Follow the movie money, not the bank money. Malaysian taxpayers paid for a sovereign wealth fund. That money moved to an offshore shell called Goodstar. Goodstar wired funds to Red Granite Pictures. Red Granite paid Leonardo DiCaprio's acting fee, paid Martin Scorsese's directing fee, paid for production costs, marketing, distribution. The film grossed $392 million worldwide. The stolen funds bought more than films. A $35 million private jet, $200 million in artwork, Monet, Van Gogh, Basquiat, a $260 million yacht, real estate in Beverly Hills, New York, London. The players were connected by family and power. Riza Aziz co-founded Red Granite Pictures. He was the stepson of Malaysian Prime Minister Najib Razak. His partner was Joey McFarland. Joe Low orchestrated everything: the theft, the shell companies, the Hollywood connections. The settlement came in 2018. Red Granite paid $60 million to the Department of Justice. The company dissolved operations. But no criminal convictions for the founders, no prison time for Aziz or McFarland. Just a civil forfeiture, a cost of doing business. The 1MDB case exposed the mechanism at the Blockbuster level. But the same structure operates at every budget tier. The indie film promising a 300% return. The Slate financing deal with 10 projects and 0 completed films. The distributor who claims marketing expenses ate all the profits. The fraud scales down, but the playbook stays the same. The pitch sounds safer than a single film. Slate financing promises to spread risk across 5, 10, sometimes 20 projects. One film might flop, but the portfolio will profit. Diversification. The same logic hedge funds use. The reality is different. Many slates are Ponzi schemes where no films get made. New investor money pays off early investors. The producer pockets the rest. Ryan Kavanaugh built Relativity Media on this model. The promise was algorithmic. Kavanaugh claimed he had developed a proprietary formula to predict box office success, the Moneyball of movies. Studios partnered with him. Films carried the Relativity logo. The Social Network, Immortals, Limitless, real titles, recognizable stars, the appearance of legitimacy. The collapse came in 2015. Relativity filed for bankruptcy, owing over $500 million. The company restructured, then filed again in 2018. The algorithm was marketing. The model relied on continuous capital raises to service debt from prior productions. When the money stopped flowing in, the structure collapsed. The mechanics of Slate fraud follow a pattern. Producers raise funds for 10 films. They produce 1 or 2, sometimes none. The remaining capital goes to development or personal expenses. Early investors receive modest returns from new raises, creating false confidence. A check arrives. A quarterly statement shows progress. The illusion holds until it doesn't. When capital dries up, the scheme collapses. Final investors are left with worthless participation agreements. No films, no recourse. Just contracts promising profit shares in projects that never existed. Tyler Joyner ran a smaller version through Dark Planet Pictures. He forged Netflix distribution agreements for a film called Legends, claimed Guillermo del Toro was involved, raised funds that went toward a $5 million Manhattan beach home instead of production. The film never got made. James Williams operated a $12 million advance fee scam, promised a slate of star-studded films, used funds for Ponzi payouts and personal assets, cars, houses, prior investors, the classic structure. Benjamin McConley raised over $60 million through Forest Capital, promised matched funds backed by secure accounts, showed investors forged bank letters on official letterhead. The matched funds didn't exist. The accounts weren't secure. McConley pled guilty to wire fraud. The legal gray zone enables this. Private placements fall outside robust retail investor protections. Securities laws that govern public offerings don't apply the same way. Enforcement gaps emerge. Prosecutors have to prove intent. Victims have to prove fraud versus simple business failure. The victim profile is consistent. Affluent individuals seeking Hollywood access, doctors, lawyers, business owners who want producer credits and premiere invitations. The credits are real, names in the crawl, IMDb listings. The returns never materialize. But Slate financing fraud still requires some films to exist, at least on paper. Forged distribution deals, fake production updates, the pretense of an actual business. The next level eliminates even that pretense. No films, no deals. Just wire transfers to shell companies and personal bank accounts. This isn't creative accounting. This is criminal embezzlement. Hollywood has always played games with profit definitions. Studios claim films that grossed hundreds of millions somehow lost money. Net points become worthless through distribution fees, marketing costs, and overhead charges. That's legal, barely. It's the math that keeps profit participants from ever seeing checks. Wire fraud is different. It's theft. William Sadlier ran Aviron Pictures as a legitimate distribution company. The films were real. Serenity with Matthew McConaughey, A Private War with Rosamund Pike. Aviron acquired rights, marketed releases, handled theatrical and streaming distribution. The business existed. The crime existed alongside it. Sadlier created a fake company called Group M. The name was deliberate, designed to look like Group M, the real media conglomerate owned by WPP. Similar enough to pass a quick glance at an invoice. Different enough to claim it wasn't impersonation. Aviron paid Group M millions for marketing services. The invoices looked legitimate. Line items for media buys, advertising placement, digital campaigns. Services that never happened. Group M had no employees, no office, no actual business operations. The money transferred to the sham company, then diverted to Sadlier's personal accounts. He bought a $14 million mansion in Beverly Hills with embezzled funds. Not from profits, not from salary, from wire fraud. The investors were institutional. BlackRock and other funds had backed Aviron's distribution slate. They expected returns based on film performance. Instead, funds disappeared into a shell company before profits could be calculated. The mechanism reveals the structural problem. Film distribution involves dozens of entities: sales agents, sub-distributors, collection agents. Money flows through multiple accounts across jurisdictions. Tracking it requires access to bank records, wire transfers, and contracts with third parties. Access that profit participants don't have. The victim's dilemma is impossible. A film grosses $50 million worldwide. The distribution statement shows $60 million in expenses. Marketing costs, prints, advertising, distribution fees. The numbers look plausible. But participants can't verify whether those expenses are real. They can't see the underlying invoices, can't access wire records, can't audit contracts with sub-distributors. The re-invoicing variation operates internationally. A distributor sells film rights to a sister company in the Cayman Islands for $1. The sister company immediately sells to the actual buyer for $1 million. The profit, $999,999, stays offshore, hidden from profit participants, hidden from tax authorities. This isn't hypothetical. It's standard practice in territories with weak enforcement. The film business operates across borders constantly. Rights get sold, resold, sublicensed. Each transaction creates an opportunity to hide money. The enforcement gap protects this. Civil litigation is expensive and slow. Most profit participants lack standing to demand forensic audits. They signed contracts that give distributors broad discretion over expenses. Proving fraud requires showing intent, that the distributor deliberately created false invoices rather than simply overspending on legitimate costs. Criminal wire fraud charges require even more. Prosecutors must prove the defendant knew the invoices were false, that the shell company was created specifically to embezzle funds. That's difficult when transactions involve multiple jurisdictions and layers of corporate entities. The Department of Justice prioritizes cases with clear victims and large dollar amounts. A Viron qualified, institutional investors, millions stolen, a Beverly Hills mansion bought with traceable funds. Sadlier was charged with wire fraud, sentenced to federal prison. Smaller schemes go unaddressed. The distributor who claims $50,000 in marketing expenses that don't exist. The sales agent who pockets advances meant for filmmakers. The sub-distributor in Eastern Europe who reports zero revenue despite theatrical releases. The same structures appear in other industries. Real estate development with subjective construction costs, art sales with opaque pricing, private equity with complex waterfalls. Any business where valuations are subjective and money flows through multiple entities becomes vulnerable. But film financing combines all the risk factors: subjective costs, international flows, minimal physical inventory, complex revenue waterfalls, dozens of intermediaries, and an industry culture that treats opacity as standard practice. These three tiers aren't isolated incidents. Blockbuster laundering through 1MDB, Slate Ponzi schemes through companies like Relativity, distributor wire fraud through operations like a Viron. They're the business model. Hollywood functions as an unregulated financial system. Subjective costs and international flows make fraud nearly undetectable. The regulatory void creates the opportunity. Film financing falls between SEC oversight for public offerings and banking regulations for loans. The compliance gap lets billions move without scrutiny. The industry's complicity sustains it. Studios, agencies, and financiers benefit from opacity. Asking too many questions about fund sources threatens deal flow. Better to not know where the money came from. The Wolf of Wall Street made $392 million worldwide. The film enriched the very system that enabled its fraudulent financing. Joe Low got a credit. Red Granite got a hit. DiCaprio got paid. When an industry's accounting is built on creative math, the line between fraud and standard practice disappears entirely.